So in this video I'll be talking about swing trading and about where to place stop loss and take profit, and also about managing your position. So let's first start with stop loss placement. There are two ways how you can place your stop loss. Now the first way is this one. At this picture you place your stop loss at a swing point, which means that, for example, in this case, you can see that there was volume accumulation set up. There were heavy volumes followed by selling activity right there. So this was a strong swing resistance. So you go short from there. And stop loss in this case would be above the high of this candle. This is significant swing point. So this is where you place your stop loss, all right? This is no volume area, volumes ended there, and you place your stop loss there. Alright, so this is the first way where you can place your stop loss. This is by far the most used way where I personally place stop loss. Now, the second way where you can place your stop loss is you place it in a low volume area. So, for example, in this case, you can see that there was a strong buying activity, there was an uptrend, and within this uptrend there was a significant volume cluster. So this is the trend setup, all right? So this is a strong support, a strong swing support right there. And since there isn't any significant swing point in here, in this area, you need to find area with low volumes. So if you look at the profile, you can see that there are heavy volumes in here, but then the volumes end and there is a low volume area. Pretty low volumes are in here, so this is ideal place for your stop loss. Alright, so this is the second method. I use this one when there is not significant swing point, and then I place the stop loss in low volume areas. The reason for that is that the price should react to the heavy volumes, like in this case. If it doesn't, if it goes past the support, past heavy volumes, then it goes into low volume area, and this clearly means that the heavy volume area did not work as a support, the support failed, and it's time to quit the trade. So that's the reasoning behind placing stop loss in low volume area. Now in here there are some rules for stop loss placement. Your stop loss should not be too tight. When you are taking swing trades, we are talking somewhere in the rough area around 100% to 400% of the average true range, which is average daily volatility. This is just a rough example of where your stop loss should be. So, for example, on the euro dollar, average daily volatility is around 80 pips. Now you already learned how to measure that, right? In some of the previous videos. So with ATR indicator, you measure that the average volatility on euro is 80 pips, which means then the stop loss should be very roughly within 80 pips to 320 pips. All right, based on this. You need to remember that with swing trades, you definitely need your trades let to breathe. So that's why this stop loss is that wide, all right? Because the price won't always react exactly at the level. Now, in here, there is my favorite stop loss management method. I call it the alternative stop loss. I use it with all my swing trades. I've been using it for many years. I found it really useful. It prevents stop loss hunting, and the main trick behind this approach is that you close your position only if daily candle closes past your stop loss. So if you look at the picture, you can see that there was volume accumulation set up in here. Heavy volumes followed by a strong buying activity right there. So those volumes were mostly volumes of strong buyers who were accumulating their buying positions there. Afterwards, they pushed the price upwards. All right, heaviest volumes in this rotation area are right there. So this is the strong swing support. Now, what happened? Price went back to the level, we went long, but before the market started to react, it went against the level, and as you can see, I placed my stop loss at the swing low. This is the swing low, so I placed the stop loss there, and the price actually touched the stop loss. It touched it right there. So under normal circumstances, I would be out of the trade right there. But with the alternative stop loss, you close your position only if daily candle closes past your stop loss, and the daily candle closed in here just a little bit before your long entry. Alright, so in this case, you hold into your trade, you don't quit it if it hits the stop loss. You don't leave a stop loss order there, it's just sort of mental stop loss for you, just a line in the chart, alright? And you wait until you see where the daily candle closes. If it doesn't close below it, then you hold the trade. Now, obviously, for money management reasons, you need to have some stop loss. And I call this stop loss a catastrophic stop loss. And this catastrophic stop loss is 150 to 200% of the standard stop loss. So in this case, imagine that this is a 100 pip distance. Let's say that your normal stop loss would be 100 pips. Then the catastrophic stop loss is this 150 pips. And when the price hits this catastrophic stop loss, you are out of the trade. Alright, you quit it immediately. You need to set this catastrophic stop loss into your platform. Alright, that's why it's called catastrophic. So no matter what happens, you always know what the worst case scenario is. But a lot of times it just happens that the price just hits the normal stop loss only to return to the entry point and into a full profit target. I started trading like this many years ago when I noticed this happening, that there are a lot of cases when the price just hit my stop loss level, then turned into a profit. So I started trading this way and my trading results really improved with that. Alright, so give it a try. It's a really useful method. I use it with all my swing trades and I can only recommend trying this out. Now here is another example of the alternative stop loss. There was a volume accumulation followed by strong buying activity. So the level to go long from is this one. As you can see, the price went past the level without any significant reaction. And the stop loss in this case was in this low volume area. If it was at swing point, then it would be in here. But the stop loss would be too wide in this case. So I placed it in here in the low volume area. What happened is that the price went past the entry point, past the stop loss, and at this point I still held the trade, but when the daily candle closed below this line, below the standard stop loss, I quit the trade at the daily close, right there. This is where you quit the trade. Alright, you quit it manually. You don't wait until the price hits the catastrophic stop loss. You close it when the daily candle closes below your standard stop loss. Alright, so that's for the alternative stop loss. Let's now talk about profit target placement. There are two ways how we can approach this. The first way is risk-reward ratio based way. The take profit place depends on the risk-reward ratio you want to maintain. So for example, if you set your stop loss to 100 pips, then if you want to trade with risk-reward ratio like this, risk-reward ratio 1, then your take profit will be also 100 pips. Alright? If you want to trade with risk-reward ratio 2, then if your stop loss was 100 pips, then your take profit will be 200 pips. Alright, so this is how you determine where to place your take profit based on the risk-reward ratio which you want to maintain. So in all cases, you need to determine the stop loss first, and from that you derive the profit target. Let me now show you that on a picture, alright? This is the same example I've already used. There was the volume accumulation setup. This was the strong resistance. There is a short trade entry. You go short from there. Now let's say that this distance is 100 pips. You placed the stop loss at the top of this swing point. So this is 100 pips. You measure that. And if you want to maintain a risk-reward ratio 1, this is actually what I personally prefer in my trading, then this is where you place your take profit. If you like to trade with higher risk-reward ratio, for example, a risk-reward ratio 2, then this is where you take your profit. Alright? This is a pretty simple method actually. Now one thing I need to mention is that there is no best risk-reward ratio. If you have positive risk-reward ratio, then you will have big potential gain, small potential loss, but you will have low strike rate. If on the other hand, you have negative risk-reward ratio, you'll be winning a lot less, potential loss will be great, but you'll be winning very often. So what I'm trying to say is this is just a matter of personal preference. This is what you prefer, either to win often and don't win that much, or win less often, but if you manage to take a winner, it will be a huge winner, right? I personally like this neutral risk-reward ratio, which is risk-reward ratio 1, where potential gain is more or less the same as potential loss. This is what personally suits me best. Now you really need to be aware that this is simple math and probability laws. There's no workaround to this, alright? This is just math, this is how it works. There's no workaround. Now, there's also another way how you can place your take profit. This one is a bit more complicated than the risk-reward ratio based profit target placement, but it's a pretty effective one. And the trick behind this one is that you place your take profit before the price hits a heavy volume area. So let's again have a look at this picture. Volume accumulation, strong resistance, you go short from there. And you want to look into the pullback area. This is the pullback area where the price went back to your resistance level. And you want to look at the volumes in this area. Those volumes. And if there is some significant volume cluster, like in this case right there, you want to quit your trade before the price reaches the heavy volumes. So heaviest volumes of this volume cluster are right there. So a few pips before that, you quit your swing short. Somewhere in here. Alright, because heavy volumes could work as a strong support or resistance zone. In this case, strong support. And this could potentially turn the price against you. And you don't really want to risk that, so it's best to quit your trade before that. Alright, so this is how you can determine where to take your profit based on volumes. Now, sometimes there could be heavy volumes very close to your short level. In that case, you better use the risk-reward based take profit, or you just risk that and you take your profit at the second resistance, or you can also not to take that trade. This is also a possibility if there is a support very close to your short. Then if you compare what you are risking with that trade and what the potential gain would be, then it's just not worth it. So in that case, it would be best not to take the trade. So let's now have a look at position management of swing trades. It's pretty simple. You enter with limit orders. You don't really need to wait for any sort of confirmation for your swings. You just leave your limit orders and wait for them to be filled. It's that simple. And you don't move your stop loss to secure your position. I don't move my stop loss unless you want to trade with risk-reward ratio more than 1. So if I entered in here, if I entered a short in here, my stop loss was right there. I traded with risk-reward ratio 1. This would be the take profit. And I wouldn't secure the position at any point. Even if the price retraced back above my entry point, I wouldn't do anything. I wouldn't quit the trade. I would leave the trade a room to breathe, to develop, and I would hope that the price would turn and hit the take profit. Alright, so if you trade with risk-reward ratio 1, then just don't secure your position, don't move your stop loss, just leave it as it is. Now, if you want to trade with risk-reward ratio higher than 1, for example, a risk-reward ratio 2, it only makes sense then you secure your position somehow. And I suggest that you secure your position when you reach the first take profit, or where you reach the risk-reward ratio 1 place, which means that if this is 100 pips, then you secure your position when the price makes 100 pips from your short trade entry. When the price gets in here, then you want to secure your position. By the way, this is your take profit with risk-reward ratio 2. Alright, this is take profit. So when the price gets there, you want to secure your position somehow. And what I suggest is that you move your stop loss to the reaction point. Reaction point is where the price actually turned. So it's not the trade entry, which is in here. This is where you entered the trade, but it is where the price turned. It is in here. This is where the price turned and where the sell-off started. This is the highest point the price went, right? This is the reaction point. This is where you want to move your stop loss to secure your position. The price should not go past this reaction point. If it hits it, you should quit the trade. I know that a lot of people use break even. They like to move their stop loss to break even. I don't really like that, because very often it happens that the price retests the break even and only then makes the reaction. And if you secure your position at break even, it would kick you out of many potential winners. So for that reason, I'm not telling you to secure your position at break even, but at the reaction point. Alright, so that's for this video, and in the next one I'll be talking about some real trades which I took. I'll be showing you a lot of examples, and in all those examples you will see how I applied those methods which I showed you in this video. Alright, so that's about it, and I'll see you in the next one.